I've prepared a very interesting day trading strategy video for you, and I have included a lot of tips that will help you improve your chart reading significantly. As always, we start our analysis on the higher time frame, and as a general rule of thumb on the higher time frame, it pays off to look for 2 to 3 confluence factors. So basically what we want to see is 2 or 3 signals that help us determine is the market more looking bullish, bearish, or there's no signal and there's nothing for us to do. So what do we have? We are here on our higher time frame, which is the 1 hour, you can see that. And since this is a daily time frame, the higher time frame is very low, but we then gonna use a very low time frame to time our trades as day traders. So what do we have? First of all, we see we are in a mature trend. We are probably here seeing wave 1, 2, 3, 4, and the 5th wave is just a double bottom. So we have technically completed the Elliott wave count, which makes a bullish reversal more likely now. So confluence 1. Then we have a double divergence. We see the real divergence here, the price making lower lows, whereas the indicator is making higher lows. So this is our confluence number 2. And we have our confluence number 3 in terms of this double bottom. It shows that the market may be losing momentum and not even able to continue on the way down. So all of those things are pointing, first of all, to a loss of bearish momentum. It doesn't make it look so bullish now, but this is a starting point. The bearish trend seems to be losing steam, and we may be able to get ready and turn this around by looking for a bullish trading opportunity. So what we do on the lower time frame as well is that we look for structures. We have a trend line here that we can use very nicely. So we connect the highs and then we get a trend line. Trend lines are, as I keep saying, a little bit more subjective, so it pays off to add one more objective confluence, and objective confluences are support and resistance or swing highs and lows. So here in this downtrend we have the 2 last swing lows. And in a downtrend, the market will unfold with lower lows and lower highs. So here we have already seems to be broken the lower low component, so the market isn't able to make lower lows, but it's still making lower highs. And we need to wait for the market to get above one of those lines so that we have also the confluence of higher highs. And once the market rolls over into a higher high, that is where usually the uptrends are starting. So we can use that going forward. So we are now on our lower time frame. This is the 5-minute time frame, and since we are day traders, it makes sense to go to the lower 5-minute time frame. And here's the trend line that is coming from the higher time frame. We have the dotted line, which is the swing points. So we want to create our trading plans now. Trading plans could be break and retests of either of those levels. First of all, we would like to see a break and a retest, and that was where we could get into trade number 1. And if we are looking for a trading plan where we can stack on top of existing positions, we could wait then for the market to get above the level 2 here, which is the higher high point we identified just 2 minutes ago, and wait for a pullback here. So let's see what happens. And in the next picture, you can see we have the market breaking the high here. So we are technically making on the lower time frame a higher high, which is great. So it looks like the market is slowly starting to roll over. But breakout approaches on the lower time frame, on the 5-minute, are not super reliable, so you're usually better off waiting for a full retest. So the market pulls away, and this is one of the drawdowns, or not a drawdown, but it's one of those challenges of being a pullback trader. Sometimes the market will run away and there's no pullback. In this case, you don't have an edge. And as a new trader, that is where many traders will get emotional, because you have done your analysis, you have waited a long time, and then it's almost there, but it's not fully there. You see that your analysis on the direction was right, you were betting all along, but you are not in it, and then it gets frustrating if you don't get a pullback and you are not able to get in. However, you have to be really okay with that. You have to tell yourself, this is not my edge is a pullback, and if I keep trading the breakouts, I will lose money long term, because breakout trades on the lower time frames are not as reliable. You can see the market already made its way into the second high point here, which is interesting. Let's see what happens afterwards. There's still no pullback here, so we are not in the trade. You can see we are making a double top here at the level number 2, which we identified on the higher time frame. Can we get back to this level? Yes or no? We cannot, so the market is not coming back to it. It is giving us a double bottom here, which is now adding confluence, and the market is back for a 3rd time here. The way it is arriving at this previous double top here is also interesting, because the market is making higher lows. Very good confluence, because This means that the market is building up momentum. Every time the market dips lower, the buyers come in earlier and earlier to push the price up. Now we have a breakout and we don't have an entry yet, but we need to wait for the retest. So we are still waiting and waiting and waiting. So now we have our retest. We draw our zone at the previous highs. So this is the double top. The market broke out of it, comes back to it and retests it. And now we have a full entry. You can see the market broke above the highs. And that is where we are finally able to pull the trigger. For stop loss placement, very, very straightforward. You can just use previous support and resistance. You can see here is our stop loss placed below the support level, below where the retest happened. And for a target, we can use a simple 2-to-1 fixed approach. So for targets, that's a little bit of a delicate issue. When I am mentoring our traders, target choice is something where a lot of traders go wrong in the beginning. You probably always want to have big winning trades. You really want to have those home run trades where you have 10, 20 R. And that's usually where a lot of traders go wrong. In the beginning, I would always recommend go for a reward to risk ratio that is much, much lower than what you first thought you want to trade. For example, I was having lunch with a hedge fund trader in Singapore a few years ago. And we were talking about strategies, and he told me that he was trading a 1-to-1 reward to risk ratio strategy in the fund. And he said that his statistics also further confirmed that the smaller the reward to risk ratio, the higher the win rate. And a higher win rate will help you preserve mental capital. What happens is if that you extend your target and you go for those huge reward to risk ratios, it is obviously harder for the market to reach the wide targets. And then your win rate will drop. And this is very, very difficult emotionally to handle because there is a likelihood of having 2, 3, 4, 5, 6 losing trades in a row is increasing significantly if your targets are very far away. And especially in the beginning, when you're just starting out, your emotions and your mindset is not really there yet. It hasn't fully developed. It is always more recommended to reduce your target, have a small reward to risk ratio, anywhere between 1.5 to 2.5. You should lean more on the shorter side. That's going to help you have a strategy with a higher win rate. Even if the winning trades are not big enough, at least it will help you to push through the learning curve, and it helps you have more winning trades, and you're more likely to keep going and not be as frustrated. So I hope you enjoyed this video, and if you did, leave a comment below, leave a like, and make sure to subscribe to the channel as well.